Hello and welcome to the Business Standard Morning Show. I'm Veenu Sandhu. Let's take a look at the stories for the day. At the COP26 climate change meeting in Glasgow, Prime Minister Narendra Modi on Monday set forth a five-pronged target for India and its commitment to net zero emissions by 2070. We delve into the major implications these targets will have for the Indian economy and the key challenges that will need to be overcome.
At the COP26 climate summit on Monday, Prime Minister Narendra Modi announced 2070 as the target for India to reach net zero carbon emissions. India's announcement came as a surprise to delegates at the climate talks in Glasgow, as it had rejected calls to announce such a target only last week. Environment Secretary R.P. Gupta had argued that it was more important for the world to lay out a pathway to reduce emissions than just achieving carbon neutrality. A net zero target refers to the date by which point a country will only emit carbon dioxide or other greenhouse gases that can be absorbed by forests, crops, soil, and developing technologies like carbon capture technology. Rich nations like the US, the UK, and Japan, as well as the European Union, went for a 2050 goal, whereas China, Saudi Arabia, and Russia have set targets of 2060. But as a developing country, it is more difficult for India to do away with fossil fuels like coal. As the world's third biggest emitter of greenhouse gases, next only to China and the US, India is also among the countries most vulnerable to the effects of climate change. According to the Global Climate Risk Index 2021, published by the think tank Germanwatch, India is the seventh most affected country by extreme weather events. India's goal of achieving net zero emissions by 2070 may seem far-fetched. But to support this goal, Prime Minister Modi made four other aggressive pledges, all of them to be achieved by 2030. The Prime Minister said that in another 9 years, India would increase the share of renewables in its energy mix to 50% from about 38% last year. He also raised the target for installed capacity of renewable energy to 500 gigawatts by 2030 from the previous 450 gigawatt goal. India's current renewable energy capacity stands at 175 gigawatt. India will also reduce the carbon intensity of its economy by 45% from 2005 levels, up from the previous commitment of 33 to 35%. Emissions intensity refers to the volume of emissions per unit of GDP. And finally, the Prime Minister said India would reduce its projected total carbon emissions by 1 billion tons by the end of the decade. India emitted 2.62 billion tons of CO2 in 2019, and it is projected to reach 4.5 billion tons in 2030. Given this context, India's target is quite considerable.
We heard just yesterday Prime Minister Modi announce 5 aspects of India's ambitions to tackle climate change. While the 2070 target of net zero will probably get a lot of headlines, more interesting are short-term ambitions by 2030, which is just 9 years away, less than a decade away. Some of these are not necessarily new. So for example, 500 gigawatts of non-fossil fuel electricity is not much more than 450 gigawatts of renewables that was announced primarily with wind and solar. So if you count hydropower as renewable as well, this is still not too different from what was being planned, but at the same time, it is extremely, extremely ambitious. Today, India's wind, solar, and other RE, excluding hydro, is about 100 gigawatts. So we want to add at least 300, maybe more, 350 gigawatts in the next 9 years, which is extremely, extremely ambitious. Not that it can't be done with the right amount of money, but A, there's that first if, but B, managing that, integrating that will require a lot of changes into our electricity system. And at some point, we will need viable storage technologies. Some of the other targets we don't have enough details on. So for example, the 1 billion reduction in emissions benchmarking that is very important. If we do accept an emissions intensity improvement, that is also quite dramatic. India was on track, of course, for its 33 to 35% improvement, which was the earlier pledge. So India has ratcheted up its ambitions, and now 45% will mean we'll have to go beyond the power sector. And this is probably the biggest shift that's going to happen. The earlier targets were very electricity centric. Now we're talking total system or total energy, and that is where it's a lot harder to actually decarbonize. One of the big unknowns is how this would treat non-commercial energy. We use a lot of biomass for more traditional uses, especially cooking. How will that evolve? Because that was anyways slowing down or winding down. So these are big changes. We will have to electrify more industries, and this may give a push, a need to drive clean industrial processes, including eventually a shift over to hydrogen. 2030 is too near for all of that to happen. And so the 2070 benchmark really gives us a long-term ambition, which will have to be broken down into parts and stages.
However, in order for India to achieve its ambitious targets, it will have to make substantial changes to its coal-reliant power sector. According to Bloomberg NEF data, more than 70% of India's electricity came from coal power plants last year.
To meet the target of reaching 500 gigawatt of renewable energy capacity by 2030 would mean adding solar, wind, large and small hydro, biomass and waste to energy power generation at a rapid pace. India currently has 100 gigawatt of renewable energy capacity and close to 40 gigawatt of hydropower. This would also mean that there needs to be a large-scale investment in battery storage and transmission infrastructure to support the growth of renewable energy in the country. To meet the other target that the Prime Minister announced, that 50% of India's energy demand is supposed to come from non-fossil fuel sources by 2030, would mean greening of several sectors, especially mobility, domestic gas usage and manufacturing. This means that India would need to invest in production and also adoption of several green fuels such as hydrogen, methanol, natural gas, etc. Officials, however, pointed out that in the near term, the future of coal and thermal power production in the country is certain. That at least for the next 2 decades, coal production in the country would continue, and so would thermal power, till the time renewable energy sources take over and lead to an eventual decline of conventional fuel sources.
India still has to frame a comprehensive plan for the 40 years from 2030 to deliver on its goal of carbon neutrality. But what underpins the progress on this issue is money. PM Modi called on the wealthy countries to contribute $1 trillion in climate finance to developing economies. This, even as a promised $100 billion in annual climate finance, is yet to be delivered after developed countries promised in 2009. Consider that in 2018, the government said India would need $2.5 trillion to achieve its 2030 climate change targets under the Nationally Determined Contributions or NDCs agreed at the Paris Climate Accords.
Prime Minister Modi announced India's updated climate commitments, including 2030 targets as well as 2070 net zero target. Climate finance will play a significant role in achievement of these particular goals, specifically the near-term. In order for India to achieve its future goals, updated goals of 2030, we will need additional access to the climate finance. For example, the MSME sector, which has been lacking the access to the finance, would need greater access if India were to achieve its updated NDC goals. It is important that the climate finance flows from developed countries to the developing world continues to flow and are scaled up commensurate with the level of investments required to counter the climate change impacts which we'll be observing due to the temperature rise that is likely to happen by the end of the century. Well, India in its first NDC asked for $2.5 trillion of climate finance to implement the goals under the first NDC. We are yet to see the detailed document, so we still don't know what the climate finance requirement would look like in the updated goals. But it would obviously be in addition to the already existing numbers which are out there.
Time alone will tell whether India will succeed with its ambitious targets or not. For now, however, it's clear that India has taken on more than its fair share when it comes to combating climate change.
What role will Intel play in India's thrust on the 5G technology and electric mobility? What will be the global semiconductor giant strategy in the country as more and more Indian players enter the fray, especially with the PLI scheme incentivizing local manufacturing? Is the company looking at India seriously as a manufacturing base? In this exclusive interview with Business Standard's Shurujit Dasgupta, Prakash Mallya, Intel India's Vice President and Managing Director for Sales, Marketing and Communications Group, answers these questions and more.
Welcome to the morning show, Prakash. There are three things which have happened in the last 1.5 years. One is obviously the move towards 5G. Secondly is the PLI scheme on IT hardware, and also EV revolution, which is highly chip driven. Looking at these three big things, how do you see Intel playing role in all these three and in terms of your strategy for India?
First of all, great to be here, Surajit. Thank you for having me. There are a few ways to look at it. Number one, silicon semiconductor technology is more important now than ever before. You look at Intel. Intel is one of the very few companies with the breadth, the scale capability we have, and the kind of innovative products we build. How we are contributing in India is three different ways, Surajit. Number one is purely innovation. When you look at innovation, Intel has been in India for 22 years. We have built the second largest design facility across the world, and it spans AI, 5G, cloud, IoT, machine learning, you name it. Most of those skills exist, and it's a great testament to talent. The second area that is very important to consider is skilling and education. When you look at some of the initiatives that we have done over several years, AI for Youth is a great example of collaboration with CBSE. And we have, over a period of time, trained over 110,000 youth on skills and tool sets of AI. Our ambition is to train 1 million citizens on AI. The third area is industry collaboration. You look at the engagement with Airtel as an example on ORAN or network transformation overall, and built on our platforms, solutions, reference architecture, software, everything combined. Or when you look at Reliance Jio, the collaboration we have with on 5G, AI, edge, everything, which is very significant. So these three areas, whether it's innovation, what we are bringing to bear, skilling and education, which raises all boats for the country, and industry collaboration. Those are three pillars.
What is the specific strategy that you have for the electric vehicle space? And also the fact that you're going to have a whole host of Indian manufacturers who are now going to build laptops in this country. And also you're having a lot of startups which are doing various kinds of hardware. In what way are you sort of supporting them? Is it through equity participation, is it through technology, or is it through both?
We are open to all options, is what I would say, Surajit. The semiconductor technology is increasingly embedded in all forms of products. We don't specifically work on EVs just yet. I would say there are several other segments which we are contributing very actively in, beyond laptops, areas like telecom network, AI solutions, edge solutions. These are several other use cases, 5G as a great example. So those are several elements that Intel will play a very strong role in the country. And when you look at those areas, our approach is few different ways. Number one, provide the technology towards making that ecosystem build out happen much more in a proactive way. So over the past years, we have collaborated with several local players, Coconix being a great example, which is a laptop brand. There are several other local companies that we have collaborated with to bring them up the path of maturity. The second area I would say is active collaboration, public-private collaboration, whether it's policy, whether it is collaboration around building an ecosystem and areas similar to that. That would be one aspect we will continue to stay engaged. And lastly would be, as you look at future forward, I would say this will be your journey. This is a marathon. This is not a sprint. So ecosystem development, as we see it, will take multiple years. It will take combination of great public policies, collaboration, startup engagement, broader ecosystem to move the ball forward. And PLI is a great first step.
There's a lot of government push to see that we also have a semiconductor manufacturing facility in the country. What do you see is the potential of India for setting up a semiconductor manufacturing facility?
First off, I would say we see tremendous opportunity in silicon semiconductor ecosystem. 90% of global semiconductor companies have got design center footprint here. You've got 2,000 chips that are designed in the country every year. That is a stunning statistic. So you have the ecosystem that is available. We see an opportunity in fabless semiconductor ecosystem evolving pretty rapidly for those same reasons. And in fact, some of the areas we are already there. The manufacturing part of the ecosystem, one, it is highly capital intensive. And the second part is it's very diverse. So you can have elements like edge, telecom equipment, 5G equipment, to laptops, to phones, to a variety of different spaces. So both of them combined would mean that you need a variety of different things to happen. You got to have very conducive policies. You need to have great infrastructure, industry and public-private collaboration, startup to industry collaboration, academic to industry collaboration on research projects. All of these elements come together and happen consistently over multiple years. You would see great progress on manufacturing and development of a semiconductor ecosystem beyond fabless. So we are extremely committed to the cause. We will contribute to it to the best extent we can.
So as we obviously have now the capability of designing the chips. So what is the next step that India should take?
I would say go down the path of creating or deepening the ecosystem. The fabless ecosystem can design the chips, but there are several other parts of the supply chain that can get built out over a period of time.
Do you see companies like Intel seriously looking at India from a manufacturing perspective?
I would say we are super committed to the country, Surajit, for everything that we talked about. The design capability, the biggest design capability outside of US that we have in India is a great testament to talent. And in fact, it is contributor to the ecosystem development.
But are you also committed to manufacture chips in India?
I would say the public information on that is what our CEO announced. We made a very strong commitment on increasing the supply chain capability. Over a period of time, we will continue to explore globally on what's the best way to solve the needs of our customers. Right now, beyond that, we don't have a public announcement to make for India.
There has been obviously a global shortage of chips from automobiles to mobiles. When do you think this sort of get resolved?
So the supply chain is impacting different industries in different ways. But from a technology point of view, I would say this is, in a long time, the highest spike we have seen on a variety of products. And the reason for that is everything technology is really mattering now than ever before. You see PCs to phones as the most obvious ones, even the areas like automotive, appliances, every segment is impacted because they all require semiconductors and chips. This will take 1 or 2 years to really address the gap. And the segments and how they evolve remains to be seen. Suffice to say, most of the segments you will see a gap for at least the next 12, 18 months.
Thank you, Prakash, for giving us time. Wonderful talking to you.
Likewise. Thank you.
Expectations are high for the Federal Reserve to lay out plans later today to taper its monetary aid to markets. But will Jerome Powell actually pull the trigger and start reducing monetary supply, even though GDP numbers for the September quarter were weak and inflation remains sticky? Watch our next report to see what the markets are discounting.
The US Federal Reserve will announce the outcome of its two-day monetary policy meeting later today, wherein Fed Chair Jerome Powell is expected to approve plans for scaling back their current $120 billion in monthly bond purchases. And this could be the first step away from the core policies put in place in early 2020 to battle the economic fallout from the COVID-19 pandemic. According to Jan Lembrecht, Managing Director and Global Head of Financial Market Research at Rabobank International, the Federal Reserve is expected to announce the start of tapering at the November meeting, where the central bank could announce a fixed monthly taper schedule that would reduce net asset purchases by $10 billion treasuries and $5 billion agency MBS or mortgage-backed securities. He also anticipates the Fed to stress on accumulated progress in the labor market and the transitory nature of supply-side bottlenecks. But given that the pace of price hikes has remained higher for longer than expected, along with the United States economy growing at a slower pace in the September quarter, market watchers are expecting a rate hike not before the second half of 2022. According to the CME Group's FedWatch tool, a widely tracked derivatives marketplace in the US, trading in federal funds futures contracts, indicates a greater than 65% probability that the Fed will raise rates in June, with a second increase expected in November. A month ago, rates market indicators signaled less than a 20% likelihood of a rate hike as early as June and a comparably negligible probability for 2 hikes next year. Let's go to G. Chokalingam, founder and chief investment officer at Economics Research, to understand what the street is discounting in terms of rate hike expectations.
Rate hike will happen only after mid-2022. Not likely to happen before that, because still, if you see the latest quarterly GDP, it has slipped in the US. Okay. So employment numbers are good, but GDP has slipped and many other parameters are not giving confidence. And secondly, very important point is that in the last 10 years, global equity market cap has more than doubled. And today, the central banks and the governments across the world, they are equally concerned about stock market. So they can't allow the market to fall badly. If any such thing happens, it will lead to severe deflationary conditions. So therefore, it would be only a soft landing of, liberal monetary policy. So therefore, I firmly believe that this will happen only after mid-2022. Even these bond purchases, it would happen. They never said they will remove, they will only reduce. So 5-10% they may reduce every month. So it will happen in a very phased manner. So therefore, I don't see the market getting impacted badly.
Given this, global cues will hold importance in today's trading session. Back home, Dalal Street could see lean volumes on the bourses today, as market participants would want to keep their positions light ahead of the US Fed outcome and Muhurat trading session due tomorrow. Among stock-specific triggers, corporate earnings of State Bank of India, Bata India and Eicher Motors, along with 39 other companies, will remain in focus on Wednesday. According to analysts, SBI's Q2 profit may nearly double on a yearly basis to 9,263 crore rupees on the back of healthy net interest margin, recovery from DHFL and lower loan provisioning. The lender's net interest income, however, is seen rising between 0.6% and 4.6% year-on-year, up to 29,309 crore rupees. That apart, services PMI data and IPOs of Policy Bazaar, SGS Enterprises and Sigachi Industries will be on investor radar today.
If you are planning to take a home loan from a bank anytime soon, there are some important things related to bank rates that you should know about. BPLR and MCLR are some of the terms you will come across. What are these and how do they impact home loan rates? Here's an explainer.
The rate settling method by Indian banks on home loans has evolved over the years. Let us start with BPLR. The benchmark prime lending rate, or BPLR, was introduced by the Reserve Bank in 2003. It is the rate applied by a bank to its most creditworthy customers. But the major problem with BPLR was lack of transparency. Banks could lend below the BPLR to privileged customers. So in 2010, the Reserve Bank of India introduced the base rate system. which replaced the BPLR system. It was used as the benchmark rate by banks for lending till June 2010. Currently, the housing finance companies lend at retail prime lending rate, which is similar to BPLR. All categories of loans were required to be priced only with reference to the base rate. Since the base rate is the minimum rate for all loans, banks were not permitted to resort to any lending below the base rate. Banks were required to review the base rate at least once in a quarter. According to the RBI, banks can fix the BPLR with the approval of their boards. The base rate is linked to the cost of raising funds, unallocated cost of resources, and return on net worth. Banks are allowed to determine their actual lending rates on loans and advances with reference to the base rate and by including such other customer-specific charges as considered appropriate. Now, whenever RBI changes the repo rate under base rate, the changes in interest rate are not automatically transferred to borrowers. Therefore, in April 2016, the RBI introduced MCLR to tackle problems related to the base rate regime. Banks stopped lending on base rate from April 2016, but loans taken between June 2010 and April 2016 from banks remained on the base rate mechanism. Banks were now asked to apply the marginal cost lending rate or MCLR as it passes on the benefit of a change in repo rate to borrowers. The main aspects while calculating MCLR: marginal cost of funds, operating costs, costs of carrying the cash reserve ratio, tenor premium. The MCLR is determined by the current cost of funds in contrast to the base rate, which is governed by the average cost of funds. It also provides transparency in the procedure followed by banks to arrive at interest rate on advances. MCLR is considered better in all respects because rates on this system are more receptive to the changes in the policy rate. Any change in the repo rate is reflected almost immediately. This also ensures that the country's monetary policy is implemented effectively across all spheres. Now, if you are planning to take a loan from a bank on a floating rate to buy a house, it will be linked to MCLR. And remember, you always have the option to convert your loans from base rate to MCLR.
And that's all we have for you today. We will be back with more news and analysis tomorrow morning. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.